You have questions, we have answers. Back with another quick clip. Here's a question for you, and it references this period of time perhaps before, when people retire, but before they start taking distributions from their retirement accounts. And sometimes that's referred to the tax desert, and that maybe there are opportunities from a tax planning perspective. What are some of your thoughts around this?
Yeah, well, I'm glad to talk a little bit about that. You know, what we call it the tax desert is essentially that time where it's real common whereas somebody nears their retirement transition, that they're entering their peak earning years where they may have, a lot of higher salary just from they built up over their career, equity compensation, maybe from a company that they work for, maybe they sell a business. There's just a lot of factors where we commonly see clients are in that higher tax rate right before they retire. And depending on when they retire, let's say you have somebody who retires in their mid-60s, kind of that common retirement age. Well, they go through a period of time where it's real common. We might see a 3, 4, 5 year period where their income, their taxable income, is way down because they've built up these, retirement assets and maybe some taxable investments, cash savings, and so on that they can use to pull from that aren't taxable type income to them in those years. So we call that the tax desert because their tax rate plummets. But then there's going to come a point when, under current rules, when you turn 72 years old, you got to pull required minimum distributions from your IRAs. And if you've done well and you've saved, well, that could push you back up into a higher tax bracket. So what we do is when we look at this, the areas that common suggestions I have for clients is, well, let's look at what type of income can we push into these lower tax years that we can go ahead and recognize that income at a lower tax rate. And then that way it also lowers that eventual tax rate of those distributions from those IRAs later in life. So some simple examples of a few things that we'll always look at, and it's not always right for everybody, but we're going to make sure we evaluate these. Might be Roth conversions, essentially where you take the money from your IRA account, convert it over to a Roth account, and you prepay those taxes at a lower tax rate. Another simple strategy might be, evaluate your charitable gifting. A lot of times we might see where clients, they make the same, X $1,000 gift every year between now and the rest of their life. Well, we might look at that and go, well, how can we plan for pushing more of these charitable gifts up front, offset it against this other income that we might want to recognize to, again, evaluate how we can really plan for those tax rates down the road. Capital gain rate spending or planning. So here is, depending on your income, capital gains might be taxed at 0% or up to 20%. Again, it depends on your income. And so working with us and our clients, we're going to evaluate those capital gains to see you might have a position in a certain stock that you've owned for many years and you've built up this capital gain. Well, let's start to diversify out of that and recognize that at a lower tax rate. So again, with these types of things, it allows us that ability to manage taxes. I'm talking here, it's not like we're going to go from have 0% taxes for the rest of your life. But if we can shave a few percentage points off your effective tax rate, that adds real value to your financial plan.
Hey, Joe, I think really what you're talking about is understanding what the long-term tax game is, right?
Absolutely.
So, there are a lot of folks that say, I don't want to pay taxes this year. I view my tax situation as being positive when I don't have to pay a great deal of taxes in any one year. What you're talking about is we're looking at over the long term and how do we maximize and fill up those tax brackets where appropriate.
Absolutely, 100%. All these are facts and circumstance based. It's based on your financial plan, the makeup of your assets. How much do you have in tax deferred accounts versus taxable accounts or tax-free accounts with Roth assets? And so they all coordinate together. And that's why it's really important for us to build those different scenarios for our clients so they can see different gyrations of the plan. And one important one we look at too is, well, what if tax rates go up? Right now the current tax laws are set to expire in 2026. What does that look like if they do expire or if tax rates go up? Where is that sensitivity in my plan? And so building those scenarios, it gives that, our clients the ability to see how taxes might impact their financial plan. And then what steps can we take today to minimize that or effectively plan for it?
Yeah, Joe, that's terrific. And maybe the whole takeaway here is just being proactive about your overall tax situation, how that integrates with your wealth plan as opposed to just letting it happen, right?
Absolutely, 100%.
Joe, thank you very much for being here today. I appreciate your time.
My pleasure, Brian. Anytime. Thank you again.
And if you or anyone else has questions they'd like answers to, please feel free to email us at qa@marinerwealthadvisors.com. Thanks for watching.